Let me ask you something directly. If someone told you right now that the way you are currently thinking about XRP's price is actively working against you, not because XRP has no potential, but because the mental model you are using to evaluate it is the exact same model that has caused most retail investors to miss the biggest moves in every major crypto cycle. Would you want to know what the correct model looks like? That is what this video is about. Not a price prediction, not a target number, a complete reset of how you think about this asset. Because the people who made real money in the previous XRP cycle were not the ones with the most XRP or the most confident price target. They were the ones who understood timing, positioning, and the psychology of markets well enough to stay in the right place, while everyone around them was either entering too late or exiting too early. Tonight, I'm going to walk you through every piece of that framework: the market cycle mechanics, the realistic price scenario structure, the specific psychological traps that destroy average investors in real time, and the 5-part practical strategy that converts all of this into something you can actually apply to your own position starting today. There is a section toward the end of this video, the investor psychology piece, that I consider the most practically valuable thing I cover. If you leave early, you will miss the one part that explains why most people who understand the XRP thesis still fail to benefit from it. Stay for that. Before we go further, this is not financial advice. Nothing in this video is a recommendation to buy, sell, or hold any asset. This is educational content based on publicly available information. Always do your own research and consult qualified professionals before making any financial decisions. If a channel that gives you the honest, structured framework instead of the hype version is what you are looking for, hit the like button right now. It tells the algorithm this content deserves to reach people who actually need it. And subscribe with the bell on, because the next video connects everything we cover tonight directly to the Clarity Act vote, and you do not want to find that one 3 days after it drops. Let's get into the reset. Start with the diagnosis, because understanding precisely what the wrong mental model looks like is the first step to replacing it with one that actually works. The most common way people think about XRP price is this. They pick a number, $10, $100, $1,000, and they build their entire emotional relationship with the asset around whether that number feels reachable. Everything they read gets filtered through that lens. Good news confirms the number. Bad news threatens it. Sideways price action makes them question whether the number was ever real. And when the market moves in a way that does not match their timeline, they either exit out of frustration or double down out of stubbornness, neither of which is a strategy. The problem is not the number. The problem is the framework. Picking a price target and waiting for it to arrive treats XRP like a lottery ticket, as if the only outcome that matters is whether the final destination number gets hit. It ignores the journey, the stages, the timing, and the percentage gains available at every step of the way. A move from $1.35 to $5 is a 270% return. That is not a failure to reach a big number. That is a return that most traditional investment products do not produce in a decade. A move from $1.35 to $3 is a 122% return. That is more than double. And yet investors conditioned to think in terms of $100 or $1,000 would dismiss both of those outcomes as inadequate, and in doing so would fail to capture gains that would be considered extraordinary in any other asset class. The mindset reset is this: stop asking what XRP will reach. Start asking what percentage gain at what point in the cycle reflects a realistic, plannable outcome, and then build a strategy around that instead of around a number someone told you on social media. Comment below right now and tell me honestly, what is the price target you have been using as your mental benchmark for XRP? I want to see how this community is actually thinking about this. Not what sounds smart, but what is genuinely running in the background when you look at your portfolio. Now let me give you the market cycle framework, because this is the mechanical structure that explains why timing matters as much as the asset you choose. Every crypto market moves through 4 distinct phases, and the phase you enter in determines the quality of your outcome more than almost any other variable. The first phase is accumulation. This is the quiet period. Prices are low or flat, public interest is minimal, and the mainstream narrative around the asset is either skeptical or indifferent. Volume is low. Social media sentiment is neutral to negative. This is where the investors who benefit most from the next phase are building their positions. Not because they have special information, but because they have the patience to be early in a market that does not reward early positioning immediately. The second phase is awareness. Price begins to move. Not dramatically, but enough that people who have been watching start to take notice. Volume picks up gradually. more content starts appearing about the asset. The narrative begins shifting from skepticism toward cautious optimism. This is still a good entry zone, but the accumulation advantage is diminishing as each new entrant competes for available supply at progressively higher prices. The third phase is the hype cycle. This is the phase most people recognize because it is the loudest. Prices move fast. Social media fills with price predictions. Everyone who did not buy earlier feels the pressure of FOMO, the fear of missing out on a move that is already substantially underway. This is the phase where most retail investors actually enter, not during accumulation, not during awareness, but during hype, when the majority of the move has already happened and the risk of a sharp correction is highest. The fourth phase is correction. Reality meets expectation. Prices pull back, sometimes dramatically. The investors who entered during hype face paper losses and psychological pressure. Many sell at the bottom of the correction, locking in losses and exiting just before the next accumulation phase begins. And then the cycle repeats. Now apply this to XRP's current position. On-chain data shows record-level daily payment volumes above 2.7 million transactions. Tokenized asset value on the ledger grew over 35% in the past month. 7 spot ETFs are operational. Goldman Sachs is the largest institutional 13F filer in XRP ETF vehicles, and the price is sitting 63% below the 2025 high. That combination, real institutional infrastructure quietly building, price suppressed, retail attention relatively low, is the textbook definition of the late accumulation phase, not the hype phase, the phase that precedes the hype phase. And the people who understand what that means are building positions right now, while the majority of retail investors are waiting for the price to confirm what the on-chain data is already showing. Let me now give you the realistic price scenario structure, because this is where the mental model reset becomes concrete and actionable. I am not going to give you a single price target. I am going to give you a framework for thinking about price in a way that removes the emotional pressure of a specific number and replaces it with a staged, plannable structure. XRP's previous all-time high was $3.84. At a current price near $1.35, that represents a 185% return from current levels just to return to the previous cycle peak, a level XRP has already demonstrated the market is willing to support. That is not a prediction. That is a documented historical reference point. A 185% return from a previous high is a realistic, precedented outcome that does not require new adoption, new institutional infrastructure, or any legislative catalyst. It requires the market to return to where it has already been. Now add the catalyst that did not exist during the previous peak. 7 operating spot ETFs, Goldman Sachs institutional 13F exposure, commodity classification under US law, a NASDAQ-bound treasury structure with Ripple's own CLO on the board, and 25% of institutional investors in a Coinbase survey planning to add XRP in 2026. Every one of those is documented infrastructure that was absent when XRP last traded at its all-time high. The question for scenario planning is not whether XRP can return to its previous high. It is what the combination of a return to the previous high plus new institutional demand flowing through new ETF infrastructure produces as a price discovery outcome. And the honest answer is that nobody knows the exact number, but the framework for thinking about it is clear. Previous high plus new demand infrastructure equals a price discovery process that has no historical ceiling to anchor to, because XRP has never been at this regulatory and institutional development stage before. Your job as an investor is not to predict where that process ends. Your job is to be positioned before the process begins in earnest. And on-chain data suggests that positioning window is the current accumulation phase. Here is the investor psychology section. And I told you at the beginning to stay for this, so let me give you everything that is in it, because this is the piece that separates the people who actually benefit from their XRP thesis from the majority who understand the thesis and still fail to benefit from it. Fear of missing out, FOMO, is the most visible psychological trap, but it is not the most dangerous one. The most dangerous one is the psychological mechanism that activates during the quiet periods, the accumulation phase, when price is flat, attention is low, and there is no visible confirmation that anything is happening. In this environment, the human brain does something very specific. It starts looking for reasons why its original thesis was wrong. The price is not moving, therefore the thesis must be wrong. Other assets are moving, therefore XRP is dead. The timeline is longer than expected, therefore the promise was false. This cognitive process is so common that behavioral economists have a name for it: thesis abandonment under temporal pressure. And the XRP community has experienced it repeatedly because XRP has spent more time in accumulation and consolidation phases than almost any other major asset in crypto. The people who exited XRP during the quiet periods, convinced by the lack of price movement that the thesis had failed, and then watched the 2021 move from below 50 cents to $3.84 in a matter of weeks, those people did not lack information. They lacked the psychological framework to distinguish between nothing is happening and nothing visible is happening. Because during the periods when XRP's price was flat, what was actually happening was the SEC litigation developing, the Ripple technology being tested by financial institutions in over 55 countries, the regulatory framework being built that would eventually produce the commodity classification, and the ETF applications being filed that would eventually produce 7 approved spot products. None of that was visible in the price chart. All of it was visible in on-chain data and regulatory filings for anyone who looked. The second psychological trap is herd mentality, making decisions based on what the majority of your information environment is saying rather than what the data shows. The XRP community on social media oscillates between extreme optimism and extreme pessimism with very little correlation to the underlying fundamentals. When price is rising, the majority says it will keep rising. When price is falling, the majority says it will keep falling. Neither of those majority positions has historically been correct at the moments when it was loudest. Smart investors learn to use social sentiment as a contrarian indicator, not the only indicator, but a meaningful one. When XRP social sentiment is at its most fearful, historically, that has been the zone where the best accumulation opportunities existed. The third trap is impatience, and I want to be direct about what this means practically. Impatience in crypto does not manifest as dramatically as FOMO or panic selling. It manifests quietly through rotation. An investor who held XRP through one quiet month decides to move capital into a faster-moving asset. That faster-moving asset peaks, corrects, and underperforms. Meanwhile, XRP makes a significant move during the same window. This pattern, capital rotating away from an asset just before its move, is one of the most common and least discussed failure modes in crypto investing. The cure for it is not willpower, it is conviction. And conviction is a function of understanding. The deeper your understanding of why you hold XRP, the more capable you are of holding it through the periods when holding it feels irrational. Now let me give you the 5-part practical framework, because all of this analysis is only useful if it tells you what to do with it. Part 1. Position gradually, not all at once. Dollar cost averaging, investing a fixed amount at regular intervals regardless of where the price is, removes the decision paralysis of trying to find the perfect entry point. You do not need the perfect entry. You need a consistent entry process that accumulates XRP over time while reducing your average cost below what it would be if you tried to time every purchase. Part 2. Define your exit levels in advance. This is the most consistently overlooked piece of investment planning in the XRP community. Investors spend enormous amounts of time thinking about when to buy and almost no time thinking about when and how to sell. Decide before the price moves, not after, that if XRP reaches a specific level, you will sell a specific percentage of your holdings. This removes the emotional paralysis of in-the-moment decision-making when the price is moving fast, and FOMO is the dominant psychological force in the room. Part 3. Manage your time horizon expectations honestly. Not every cycle produces a move in your anticipated window. The XRP thesis is well constructed. The infrastructure is real. But markets operate on their own timeline, not yours. If you have capital in XRP that you psychologically need to have performed by a specific date, that need creates emotional pressure that leads to decisions made from anxiety rather than analysis. Only hold XRP with capital that can remain positioned for as long as the cycle takes to resolve. Part 4. Filter your information environment. The crypto information landscape is not designed to help you make better decisions. It is designed to keep your attention, and fear, excitement, and outrage are the most effective attention retention mechanisms, not accuracy. Identify 3 to 5 high-quality sources of XRP information, on-chain data platforms, institutional research, regulatory filings, and reduce your exposure to social media price sentiment, which adds noise but not signal. Part 5. Measure your psychology as seriously as you measure your portfolio. After significant price moves, both up and down, spend 5 minutes asking yourself honestly, did I make any decisions in the last 2 weeks that were driven by fear or excitement rather than by my documented strategy? If the answer is yes, identify the specific trigger and address it in your plan before the next similar event occurs. This practice, treating your own psychology as an asset to be managed, is what separates investors who consistently benefit from their convictions from those who understand the thesis but cannot stay in long enough for it to pay. Here is the complete picture I want you to take from tonight. Most people are wrong about XRP price, not because XRP has no potential, but because they are using the wrong framework to evaluate it. They are anchored to absolute price targets instead of percentage gains. They are entering during the hype phase instead of the accumulation phase. They are making decisions from FOMO and fear instead of from a documented strategy. And they are abandoning thesis positions during quiet periods because they cannot distinguish between nothing happening and nothing visible happening. The framework that actually works is simpler than the one most people use. Understand which phase of the market cycle you are in, build your position during accumulation, define your exit structure before prices move, filter your information environment to signal overnoise, and manage your psychology with the same discipline you apply to your entry and exit decisions. XRP's regulatory clarity is the clearest it has ever been. The institutional infrastructure is the most developed it has ever been. The on-chain utility metrics are at record levels, and the price is 63% below its previous peak. That combination is not a sign of a failed thesis. It is the environment in which the correct framework produces outcomes that the incorrect framework misses entirely. If this video changed the way you are thinking about how to evaluate XRP, not where it is going, but how to think about where it is going, smash the like button. You stayed for the complete breakdown, including the psychology section I told you to hold for, and that tells me you are approaching this seriously. Share this with one person in your network who has XRP but is stuck in the wrong mental model. The price target trap, the timeline pressure, the herd mentality cycle. Because the framework reset we covered tonight is the most useful thing I can give someone who holds XRP and keeps making decisions they regret. Subscribe and hit the bell because the next video takes everything we covered tonight: the cycle positioning, the realistic scenario structure, the institutional data, and maps it directly onto the CLARITY Act timeline and what each legislative outcome means for each phase of the framework. That is a video that connects every piece of this into one complete picture, and you do not want to miss it. Tell me in the comments, which of the 5 psychological traps we covered tonight is the one you are most guilty of? Be honest, because recognizing it is the first step to addressing it. I will see you in the next one.